So good afternoon, friends. I, C.A. Gyanchand Mishra, Vice Chairman of the Committee on Management Accounting, welcome all the delegates on this very important webinar hosted by the committee, Investment Strategies for Value Creation. Investment is basically very integral part for a human being system. We have to have good investment strategies in order to get some good returns and, of course, to secure our future.
Hello? Not able to hear you. Hello? 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 Oh. Okay.
About the types of investment they would like to include in their portfolio, which is essentially a big briefcase carrying investors' financial assets, including stocks, bonds, property, mutual funds, cash equivalents, and of course, to other areas of their interest of investment. There are basically three styles of investment: conservative, moderate, and aggressive. We all know the conservative investor is always very precise about investment, whether he is getting lower return or he is getting some moderate return. However, the moderate investor is an investor who is always trying to balance the risk and return of his investments. However, the aggressive type of style of investing is basically where the people invest in the, especially in the equity markets, which is always very volatile, and he is able and he thinks that he can take more risk about his investments. Friends, some of the most common investment strategies are value investing. Value investing is basically done on the basis of the research and, of course, the profile of the company, the nature of the business, and all these things are included for the value investing. Momentum investing is the second type of the investing strategy, and in the momentum strategy, basically the investor keeps on buying at the lower and tries to sell on the higher on intraday. And there is one concept of short selling. Short selling is done on the higher level, and the investor tries to purchase the position at the lower level. This is the momentum trading, and momentum is strategy. Growth investing is the another one, third one. Growth investing is basically, again, a long-term sustainable investment strategy of the investor, in which the investor tries to have most of the crucial aspects of the investing, and he takes a long-term vision for his investment to have maximum growth of his capital. The fourth one, last, is cost averaging strategy. When the investor invests in one stock and he sees the stock value has come down substantially, then he has one opportunity to have the averaging of the cost. Suppose one person purchases any stock at rupees 100 and the stock comes at rupees 20, then he tries to keep averaging up the stock by purchasing at rupees 20 also. So friends, role of investment strategy for value creation is very important, and it is basically investment which keeps so we really apologize uh, disturbances because of this internet connections. So friends, we were discussing the role of investment strategies for value creation, and investment strategy plays a very key and vital role in value creation for an investor, and it involves a very strong process of involving deep analysis of investors' goals, their interest, and the need of the funds when it will be needed by the investor. Friends, today we have very senior speaker amongst us, K. Suresh ji. I am just giving a brief profile of our learned speaker. Suresh ji is basically associate member of the Institute of Chartered Accountants of India and Institute of Company Secretaries of India. He has more than 30 years of experience in the area of finance, securities market, accounts, internal audit, and marketing. He is fellow member of Insurance Institute of India also. Presently, he is serving as President and CEO India Cements Capital Limited, Director India Cements Investment Services Limited. He has been Assistant Divisional Manager, United India Insurance, and Vice President, Apple Trade Corporation Limited, and Finance Controller and Company Secretary of India Cements Capital Limited. So with this background of such wonderful speaker, I welcome the learned speaker K. Suresh ji, and of course to all the delegates who have joined this program. Friends, the Committee on Management Accounting is always trying its best to provide the good informational system, the best webinars at our level, and it has one flagship course on diploma in management and business finance. So I will not take much time. I welcome once again to each and everyone present over here. I am thankful to the officers of the Institute for organizing such wonderful webinar. I hand over the session to our learned speaker, K. Suresh ji. Thank you.
Thank you, sir. Respected Vice Chairman of the Management Accounting Committee. Of course, my Chairman, Mr. Rajendra Kumar, whom today I'm missing, is my mentor as well as my well-wisher. Of course, he is the past President of Hindustan Chamber of Commerce, where I am presently President. Regarding today's topic, I have to thank all my colleagues who have given me this opportunity of sharing some of my thoughts on investment strategies for value creation. Actually, when I discussed with Mr. Rajendra Kumar, first I asked whether it is about individual or company. Actually, he conveyed to me that it is for the company, actually, he was telling me. Anyhow, I will do one thing. I will first say a few things for the value creation for the company. Then I will come to the individual part also, so that both things we will cover it at the earliest possible time, no issues. So the value creation is very, very important for everybody's entity as well as personal life also. Unless there is a value, then there won't be any demand for any of your services, products, or for yourself for the future also. That's why this topic is attempting to say a few things about value creation. From industry perspective, first I want to talk, because as a chartered accountants, we are all responsible for the value creation of the companies. That's what first I am giving importance to that. Next, we can talk few things about the personal investment things also. What is value creation? Actually, it is nothing but adding some importance to the entity or the enterprise so that it will have its own pulling power. Rather, it will have its own extra exploitation of value, so that the buyer or whoever wants to have an eye on you will have a proper view of your company or the entity. So creating values naturally helps sell the customer the good products. Also, the shareholders in the form of increasing the stock prices, so that future, if you want to raise any money, you will be in a position to raise further money from the market also for expanding your operations. So primarily, value creation is nothing but rather a process whereby I'm ensuring a better products to the customers. I'm ensuring enhancement of value, rather stock prices for the investors. Similarly, all stakeholders are benefited from that value creation, so that the entity becomes a full-fledged entity to raise capital from the market tomorrow. Why we need value addition for the company, I'm telling you. So it is really essential, or rather it's a winning value addition, essential to define where and how a company can have, rather create the new as well as the strategies, delivering the fast. See, a winning value combination, a winning value creation is strategies essential to define where and how a company can excel in systematic change, sustaining the core, creating the new, and delivering fast. All of you know that value creation becomes more and more tough because of a lot of changes are happening. And similarly, you have to sustain your core the business, and also you have to create a new and fast. There's always a gap between what the objective of the company, corporate ambition, as well as what we want to do to achieve the value addition. So it becomes important for the management teams to bridge this gap by means connecting the dots. That's why then only whatever I'm aiming to improve the value addition to the organization will become a reality. Rather, it will be converted into operational reality. Corporate leaders have to be willing to implement sustainability, which has to be embedded as a part of the business strategy. See, in the course of value addition, I should not lose the sight of sustainability. So I have to ensure one side that, the other side also I should ensure how can I improve my business purposes. It can also mean to switch perspectives from the philosophy of increased efficiency to a more sustainable view that ensures only producing what is necessary, and that creates an ecological, economic, and social value. So ultimately, I have to ensure, rather I have to fence it in such a fashion that value creation doesn't shatter the certain sustainability. That's very, very important. I have to, within the framework of ecological, economic, and social values, I have to ensure the value creation. What are the aspects I have to look into for the value creation of, rather value addition of a company? I have to review the following things. I have to review the current, what are the strengths, my strengths, weaknesses, what are the opportunities available, what is the voice of the customer, which is very important. I have to listen to the voice of the customer. In the absence of that, I may be a failure. What is the environment available for me? Is it competitive? If so, who are all there? What I have to gather information, I have to do that. Then what kind of strategy, business strategies presently we are having? Product innovation, which is also very important. Then comes the operations. Operations, we have to see that social responsibility. Am I giving back to the society? Processes, what are the processes I am going through? Practices, what kind of business practices I am adhering to? Then what kind of systems in place? So these are the things which I have to review in order to create value. See, corporate culture is very, very important, which we have to keep in mind always, that is nothing but values, norms, and attitudes of a company. It is a product of the influences affecting the corporate decisions, actions, and behavior. Ultimately, culture is about defining a shared set of enforced expectations. Please understand that culture of the organization, everyone should understand. Otherwise, the value creation may not happen at all. If you deviate from yourself, the corporate culture, then it will be a failure for the entire team also. So you must always have an eye on your culture of the organization. That's why people largely neglect the fact that corporate culture determines sustainable corporate development, the future direction of the company, which is very, very important. If in order to have a value addition or value creation for the company, I have to have rather follow my own corporate culture also. Next, I want to see that major changes. All of you know that every day changes are happening in the form of systems, technology, and even procedures, processes, and even a new product, everything, going on happening in this world. When you compare it to last 10 years, every day there's a change. That's why there's no normal anymore. Every day is a different. So the product and the company cycles have changed drastically. Procedures and processes have become more efficient, faster paced, and above all, short-lived, following a universal expectation to do more faster than less. So now the expectation is that always, we have to be on our toes. Otherwise, we'll be losing the opportunity of doing a value creation for the company. So now the question comes is, how can the company avoid this type of trap? What I have to do is, first I have to recognize, understand, and live your culture. A marriage is not only on the wedding day, nor does the family live only on the happy holidays. Like a marriage or family, the dynamics of corporate culture are ongoing and pre-meet every aspect of company's operation. It is not a static one, it's an ongoing thing. So knowing corporate culture encompasses recognizing, explaining, and understanding different patterns of thought and action involved in the company. Ultimately, it is about figuring out why your company works the way it works. So you have to first understand that, recognize that, then you have to live up your culture. Brand. In order to add a value to my company, positioning refers to what? Everything the company does to connect its business, products, and services with the customers. Positioning of the brand really gives you a solid presence in the market. So a well-positioned brand enables the company to charge what? A premium price, grow customer loyalty, and introduce new products and services. Building a clear and compelling brand is the cornerstone of increasing the enterprise value. So this is what I want to tell you, that unless your brand is positioned, you cannot expect all these things. What is that? Premium price, customer loyalty, introduction of new products and services, and this will be really adding value to the total enterprise. So companies' corporate culture and brand image are connected. Always we should also have that in mind. Corporate culture as well as the brand is connected. Customers identify your brand and values that it represents. Therefore, your company's brand image represents a strong corporate culture. Brand positioning is important. Why? Because it gives you a power, unique selling proposition, helps you to stand out from the competition. You know that we are all having competition everywhere for every product, every service. So unless there is a brand positioning, we cannot overcome that particular negative thing, rather competition. It enables you to customize offers to meet both customer and market demands, which is also very useful for you. It helps you to earn loyal and repeat customers. So in order to sustain your business, in order to ensure continuity of your top line as well as bottom line, this type of value creation, that is brand positioning, definitely earn good customers and also repeat customers. Customers also will be coming back to you. Most important things, already I mentioned, voice of the customer. So when companies do strategic planning, they typically look at past performance and forecast the future potential, or they benchmark their business against the competitors. So what in actuality companies need to understand their customers' unmet needs and design the products or services accordingly to increase the revenue and enhance the value. So ultimately, you are going on producing something, but what is the customer's needs? You may suppose out of 12 things, you may fulfill 5 or 6, But what about the 8, balance 8 or 7? So you have to see that your product or services are fulfilling the customer's needs. In the absence of that, you cannot increase your revenue or enhance your value. Ways to know the customer's need is, of course, a lot of methodologies are there. One is focus groups. Here, you will make a group and you will analyze and you will come to a conclusion what they want, what they think about brand, what kind of gap is there, then you bridge that. Next is customer survey. Straight away, you will send questionnaires to various people, different populations. And from there, you will find out what is their final need or etc. And accordingly, you will design your branding or your own processes, etc. And another important thing is in this world of technology, social media monitoring also very important, so that anything comes wrong in that also will make you to correct your course of action, or anything comes good also make you to enhance the value of the enterprise. So you have to monitor the social media also. Most important thing is having I designed a program or process or various strategies, who is ultimately going to do that? Employees only. So if at all, unless I engage them by means of creation of targets and giving them some incentives and rewards, I cannot achieve what I want to create value for the company. So the value creation for the company ultimately depends upon how you are going to engage your employees by means of targets, as well as giving incentives and rewards once they complete their goals. Next is market. Your value creation plan has to be grounded within the realities of your market. Now that you are confident that your offer meets a need or solves a problem, therefore, is likely to find buyers, you need to understand the context in which you launch the business. So you have to understand the whole market in which you are going to play. Accordingly, you have to design your things. Analyze the market for players involved, current trends, etc. Suppose I want to put in place a strategy for the value, addition for the enterprise. First, I have to see the ground reality of the market and also who are players there and what are they doing, what is the current trend, where I am. So I have to study that. Then only I can design a proper strategy for the value creation. We must distinguish two markets, global as well as the niche market. Studying the global market helps you define your mission, vision, strategy, and business model. It allows you to detect sector trends, changes in purchasing behavior, consumer needs, regulatory constraints, marketplace, and changes in other things. So finally, understanding the market is very, very important. Of course, as a part of adding value to the enterprise, rather creating the value to the enterprise, risk reduction methodology also we have to adopt. Opportunity stroke strength, if it is this type of situation is there, then it is nothing but the challenges are at the core of the future strategy. Opportunity and weakness means we can do to seize this opportunity, new projects and potential growth can arise from here. Risk and strength, then it is a crucial question. You have to ask how to control here. Risk and weakness, of course, very dangerous. So you have to avoid such situation. Next comes the resource allocation. When companies first develop a value creation plan, they are looking into new grow enterprise value while relying on the same strategies, same investment levels that got them to their current position. If you are targeting higher, you will need to look at your capital needs and investment tolerance to hit those targets. So ultimately, value creation leads to the financial planning also. Project risk having an immediate impact on the resources. In addition to personal resources also include equipment, services, supplies, goods, materials, budgets, and funds. So realistic project and resource planning must always take the project risk into account. This is very, very important. In case a risk directly impacts the resources in the project, then if cost rise, the processing time increase, the project will be terminated in the worst situation. While risk cannot be eliminated, it is possible to meet them or prepare for them. If you have already evaluated a risk concerning a profitability, effects, and possible countermeasures, then you can respond quickly and efficiently. So proactive resource planning reduces the likelihood of risk from the outset and helps you to respond quickly by reprioritizing troubleshooting, and countermeasures. Synergy. The word synergy is very, very important. This is what will help you to enhance the value of an enterprise. Mostly it is achieved by merger and acquisition. Normally we know, all of you know that. So cost reduction helps you because M&A will help you to have cost reduction, tax benefits, unused debt capacity, surplus funds, assets write-up. So cost reduction means economics of scale and economics of vertical integration. Tax benefit means will unabsorbed losses of the target company can be written off. Unused debt capacity. If the target firm has a lower debt equity ratio than the bidding firm, company can lead to incremental tax shields. Surplus funds, excess funds in the target firm may be turned into positive NPVs in the combined organization. Assets of the target firm may be revalued at higher market value, and the resulting incremental depreciation may produce a tax shield. So these are the things available under the MMA. Synergy is available. So it's a magic force that allows for enhanced cost efficiencies of the new business. Different types of energies are there. Operating synergy, financial synergy is there. So operating synergy is nothing but most economically sound system. Financial synergy is how we can allocate the finance. So operating synergy, if you talk about that, theory of merger states that economics of scale exists in industry, and that before a merger takes place, the levels of activity that the firms operate at are insufficient to exploit the economics of scale. So here the mergers are happening that we want to explore the economics of scale. Operating economics of scale are achieved through the horizontal, vertical, and conglomerate mergers. So operating economics occur due to indivisibilities of resources like people, equipment, and overhead. So productivity of such resources increases when they are spread over a large number of units output. So when this type of synergy happens, naturally, the enhancement of value will be there. Expensive equipment in manufacturing firm should be utilized at optimum levels so that cost per unit drops drastically. Operating economics in specific management functions such as production, R&D, marketing, finance may be achieved through merger between the firms which have competencies in different areas. This is another advantage of getting a synergy this. Operating economics are also possible in generic management functions such as planning and control. So according to the theory, even medium-sized firms need a minimum number of corporate staff. So the capabilities of corporate staff responsible for planning and control are underutilized when such a firm acquires another firm which has just reached size at which it needs to increase its corporate staff. The acquired corporate staff would be fully utilized. So here you are maximizing the available resources for the purpose of economics of scale. Vertical integration, combining firms at different stages of the industry value chain, helps to achieve the operating economics. So merger strategy is nothing but 1 + 1 makes 3 is the main idea behind that. So the key principle is that buying a company is to create shareholder value over and above that of some of the two companies. Two companies together are more valuable than two separate companies. So when times are tough, strong companies will act to buy other companies to create a more competitive, cost-efficient company. So instead of struggling, during a tough period, I will try to buy other companies to create a more competitive edge for me. The companies will come together hoping to gain a greater market share. So by means of this type of acquisition, naturally the market share will go up, or I can achieve greater efficiency. Target companies will often agree to be purchased when they know they cannot survive alone. Companies often merge in an attempt to diversify into another line of business. This is another form of value creation. I can buy some companies to create another chain of business. The history of mergers is replete with the diversification transactions. The track record of these diversifications with notable exceptions is not very impressive. However, this type of transactions are happening that do not involve a movement to a very different business category, have a better track record. Companies experience greater success with horizontal combinations, which result in an increase in market share and even with some vertical interactions, which may provide other economics benefits. This is a very important thing. Growth. So fundamental motives of M&A is growth. Always a growth leads to value creation only. So it is seeking to expand areas, rather expand or faced with a choice between internal and organic growth. There are two types of growth. Everybody knows that. Either I can do organic or inorganic, rather through internal growth or organic growth, I can do that. So internal growth is sometimes possible with if your resources are good, your products are good. But organic growth is possible only through, external growth is possible only through acquisition only. Growth through M&As may be much more rapid process, although it brings with its own uncertainties. Sometimes it may be a failure also. If a company seeks to expand within its own industry, they may conclude that internal growth is not an acceptable alternative. For example, if a company has a window of opportunity that will remain open for only a limited period of time, slow internal growth may not suffice. So in order to scale up their operations, thereby increasing the value of the enterprise, they may go for the buying of a new line of, rather another business from the same line of business, another company from the same line of business. As the company grows slowly through internal expansion, competitors may respond quickly and take market share. That is the drawback. If you lose the opportunity available to acquire a company of your own segment, then the competitors may take an edge and you lose the market share. So advantages that a company may have dissipate over time. The only solution may be to acquire another company that has the resources, such as established offices, facilities, management, other resources, so that your starting time is saved, everything is saved. There are many opportunities that must be acted. In addition to economics of scale and the diversification benefits, there are two other economic motives for merger and acquisition: horizontal integration and vertical integration. Horizontal refers to increase in market share and market power that results from acquisition mergers. Vertical integration refers to the merger or acquisition of companies that have a buyer-seller relationship. So horizontal, of course, integration, we all of you know that combinations that result in increase in market share. So one side of the spectrum is pure competition, which is a market that is characterized by numerous buyers and sellers, perfect information, homogeneous, undifferentiated products. So given these conditions, each seller is a price taker with no ability to influence the market price. This is the advantage of horizontal. So by merging, what happens? Automatically the value addition is, or rather value is created for the enterprise by means of staff reductions. Mergers tend to mean job losses, mostly from reducing number of staff members from accounting, marketing, or other support functions. Job cuts may also include CEO, who would typically live with compensation package. Economics of scale, yes, a bigger company placing the orders can save more on cost. Mergers can translate improved purchasing power to buy equipment or office supplies when placing larger orders. Acquiring a new technology to stay competitive, companies need to stay on top of the technological development and their business. Improved market reach and industry visibility, a merger may expand two companies' marketing and distribution, giving them new sales and opportunities. So due to improved financial standing, bigger firms have an easier time raising their capital than smaller one. So because of size. Of course, overcoming the entry barriers, mergers acquisition is one of the ways for smooth market entry, as the goodwill of the other company and other brand will help you to enter without any initial hurdles. These costly barriers to enter otherwise would make a startups economically unattractive. Eliminating the cost of new product development, buying established, reduces the risk of startup wins. Low risk as compared to the developing new products. Increased feasibility and speed of diversification, which happens quickly, so that the introduction of businesses happens without any loss of time. Acquisition is intended towards avoiding excessive competition and improve competitive balance of industry. So by ultimately, whatever I just spelled out definitely is going to create value for the enterprise. So an enterprise, business enterprise, it may be manufacturing or it may do services, definitely aims for adding value to its business, because without value addition or without creating value, the entity cannot be felt as an important entity, And similarly, for that only, there are various methodologies we have seen, merger acquisition, similarly synergy, and also some other methodologies available. So that totally the idea is that according to the situation, if you are new to market, then how to go about. If you are already in the market, how to scale up. Similarly, in order to reduce the cost, what you have to do. Similarly, in order to get more funds, what kind of strategies we have to do. So every action, whatever we talked so far, definitely will lead to enhancement of value to the organization. So I am now coming to the next topic, namely the investment, which already our Vice Chairman talked about. Are you able to see the screen now? See, this is, I'm talking about the personal perspective. So as an individual, definitely we are all interested what kind of things we can do, when to do, how to do all those things. So I'm going to talk about that also. Various investments definitely available in India. The philosophy of savings, first I want to tell you is that first you have to earn money, plan your expenses, save at least 25% of your earnings. Then you divide that earnings into investment options, make sure that it is a long-term and short-term investment, and some of investment amount should be in liquid nature. Monitor the progress of investments, then try to increase your investments and cut down the expenses. Finally, you have to reach a goal of investing 75% of your earnings. So initially you have to start with 25% of your earnings, but finally you have to go reach the goal of savings of 75% of your earnings. This is possible provided you avoid unwanted expenses. So this is the logic of savings. I have to earn money, then I have to plan my expenses. 25% of the earnings must be first started. Then of course long-term, short-term, then review of your earnings. Then you have to increase your investments, cut down the expense, ultimately reaching the 30% target. These are the avenues available for you. Fixed deposits, recurring deposits, public provident funds, new pension scheme, gold, silver, IPO, stock market, real estate, mutual fund, bonds, post office scheme. My dear friends, please understand that even though these avenues are there, it varies from person to person, first of all, and the risk also varies from product to product. Each product is not unique. We have to understand that. Every product has risk, rather degree of risk is different from product to product. I'm just giving a chart of what are the risk, how the risk matrix is there. For example, now due to technology and other things, particularly new gen people investing in cryptocurrencies heavily, I think you would have observed last 2-3 months, things are going very bad for cryptocurrencies. And moreover, it's not regulated in many of the countries, including India. So effort, return, risk, if you see the matrix, cryptocurrencies are showing always red in all 3 columns. Stocks, yes, they are also very high in all the 3 matrices. ETF, of course, very low effort-wise. Return risk also very high. Unit trust, mutual funds, same thing like ETF, low efforts, because you need not have any knowledge of technical knowledge or fundamental knowledge of the scripts or anything. Just you have to invest in ETF or mutual fund unless you know the basics of that. So, but return and risks are directly proportional. Higher the risk, higher the return. Bonds, effort is low, risk is less, return also less. Then endowment policies, always effort is low, return is low, risk is low. Savings, you won't get anything. Where savings is after all negative return. Nowadays, of course, we are getting a small interest on your savings bank also. Now, different asset classes are there. Debt, real estate, equity, commodities. If you go to the debt, fixed deposits, floating rate funds, PPF, then NPS, government bonds, senior citizen savings schemes, endowment policies, all those things are there. Debt funds are there. Within that, you are having liquid funds, liquid plus funds, gilt funds. Then comes the real estate, residential plots, commercial plots. Of course, now a new product is available, real estate investment trust, REITs, then real estate mutual funds also available. Equity, of course, you are having mutual funds, ETF, unit-linked plans, direct equity, commodities. Of course, you are having gold, silver bars, others, gold ETF, gold bars and coins, gold mutual funds. So mutual funds, if you come beneath that, you are having index funds, equity funds. Then equity funds, you are having sectoral funds, equity diversified, mid to small caps, saving, tax saving, non-tax saving, balance funds. So this much categories are available. Of course, each will have a different return also, as I shown in the previous slide. Debt will have a different return, real estate will have a different return, equity will have, commodities will have, of course, mutual fund also will have same like equity only, but the risk is a little bit eliminated because some expertise is handling your funds. That's why the risk is to some extent eliminated. Of course, directly you are associated with the market only. Out of mutual funds also, you can go through all these different types of funds according to the risk appetite. Common types of investment risk. We have to understand this risk very important. Market risk is there, whether it's bullish or bearish. There's a bearish market, yes, you lose money. Default risk is there actually. Suppose something happens to a company, some default is happening, then the company's value will go down drastically, the shares will come down. There's a risk is there. Interest rate risk is there. Whenever the RBI comes and does something, or whenever the interest rates are going up, naturally the financials of the companies will be affected. So the interest rate is there. Credit risk is there. Liability risk, of course, that is maintain your loan account when your investments going down. Current risk, rather currency risk also is there. Of course, everyone knows that. Now the rupee depreciated to a great extent. Almost it is touched 80 rupees now per dollar. So this currency risk also has a rather impact on the investments. Next important thing is age and the types of investments. We are having, when I am 20, yes, I can take higher responsibilities. I can take high risks and I can go for mutual funds, equity and other plans, life and health insurance plans, I can go there. Nothing wrong in that because my age 21, I would have started my, rather I start my earnings. So naturally you can take risk also. So risk appetite will be more there. So you can go through these investments. 30s, of course, you have to slightly be careful. Equity schemes and a little debt. So here comes the combination of a small debt is coming to that. So that next is tax savings also come to this particular stage because your salary will have a tax impact. So think long term for you and your family, debt instruments, lower risk. 40s, investment. Here the balanced funds. Instead of debt fund, now I'm going to the balanced funds. A balanced funds, all of you know that nothing but a combination of debt and equity, tax savings, and retirement plan starts only here. So in order to add your value to your life, or in order to have a wealth for you, naturally the retirement plan has to be put in place. So it is the right time to start at this age. 50s, of course, systematic transfer plan to shift money from equity to debt funds. You are shifting totally to something else so that you need not lose your capital, should not lose your capital. So when nearing retirement, shift to conservative investment. So slowly the degree of risk comes down when age is catching up. That's why it is always advisable whenever we are catching up the age, the risk perception should also be considered, and accordingly we have to invest with our age. Of course, when you come to the 60, you have to be very, very careful. You have to need low risk plans that offer regular income. Ultimately, you need income after retirement. So it is your duty to see that you are investing in such instruments which gives you regular income. If you see the profile of investments, of course, this data is a little bit outdated in the sense few years back. But the perception, if you see the whole mass where they are putting their money, direct equity 21%, fixed deposit 20%, insurance 14%, savings deposit 12%. Other than that is only a single digit only. So we are putting most of our money into the direct equity. Fixed deposit also we are having more also. So that shows that our population either rather divided into equity as well as fixed deposits. Maybe youngsters may be on the side of equity, The retired people are maybe on the side of fixed deposit, or high risk people on the equity, low risk people on the fixed deposit and other instruments also. So term life insurance, whole insurance. So creating value for your life, insurance also very, very important. You have to understand what kind of insurance one should take to ensure your continuity of your life, for your rather continuity of style of living for the family members in the event of any unwanted things are happening to you. Term insurance, whole life insurance. Term insurance is nothing but totally it covers you, gives you at low cost, and it is a beautiful product in my opinion. When you are young, you have to take this product to ensure your wealth, to ensure your family, rather to insure yourself. This is the best one when you are young. Why? Whatever the premium, for example, I am taking a policy for 1 crore. Whatever the premium for 1 crore, when I start at the age of 25, will be the same even at the age of 55. That means what? By time, when time passes, the premium will become a meager amount, but at the same time, you are covering up your life for a big sum. That's why my advice to all youngsters, please have this term insurance without fail. You need not spend on life insurance. Life insurance is meant for people who are in the mid of, who didn't take any insurance at the initial stage, then they can go for this. Whereas the youngsters can take straight away this, because life insurance returns are not more than 4 to 5%. It's like a fixed deposit only. Only thing is it covers your life, rather insures your life. That's why my advice for the people is, wherever possible, term insurance is the best thing for the insurance of your, rather insuring your life. Bonds, of course, nowadays, my dear friends, please understand that bonds are available even to your retail investors through various, media, rather platforms. You can buy the bonds, particularly government secured bonds at a rate of 7% or 7.5%, which is more than the fixed deposit available, so that you can rather allocate a portion of your money capital to ensure that you are earning a fixed income from there at a higher rate of FDs. Normally, our mentality or our idea is that to put it in FD only, but whereas nowadays, lot of government bonds, rather secured by government, rather guaranteed by government, bonds are available at a reasonable rate. Only minus point will be, there will be a lock-in period. You cannot withdraw immediately. 3 years it may be there, or 5 years. For example, even you can have a Tier 3 bonds of big PSU banks, PSU banks, you can have that. Public sector banks, you can have Tier 3 bonds, which gives you 10%, 9%, or 11% also. Of course, there will be a lock-in period of 5 years, and there will be a choice for them to recall. So normally, they won't recall. They won't recall at all. Unless interest rates are skewed heavily, they won't recall. That means you are having a choice of earning more for a long period. So we have to use this. Debentures, of course, there are risks are there. Provided, better rated debentures we can invest. But here, the problem is that you have to monitor such investments, because anytime the rating agency may downgrade the rating, naturally your money is at risk. So these investment debentures is a risky nature, but good returns are available. With the proper rating, you have to invest. Capital markets. I always prefer people to invest in capital markets because of simple reason that it is easy liquidity, risk diversification. As I told you earlier, the normal thumb rule is that we have to always, what is your age? From there you reduce 50. From there, from 100, you reduce your age. To that extent, your fund can be allocated in equity. Suppose my age is 75, I cannot allocate more than 25% of my capital into equity. If I am 30, I can allocate 70% of my capital into equity. So we have to have this thumb rule to invest in equity market, because it gives you liquidity first. Anytime you can liquidate that, risk diversification is there, maximum returns. It's better than FD. Of course, risk is there, as I told you in the earlier box, but maximum return is available. You are having tax benefits nowadays, long-term taxes are there, short-term taxes are there, price transparency. Of course, now, unlike our olden days, the prices are very transparent and you can yourself see that and buy it. For successful trading, we have to treat trading like a business. If you trade like a business, you can make money. Protect your trading capital always. This is with regard to trading, I'm telling you. Trading is different from investment. Investment is different from wealth creation. See, wealth creation is nothing but a totally different idea or a plan for a very, very long term. I am planning now for a period of 20 years and I'm investing. That's a wealth creation. I'm not going to touch anything. Whereas investment is nothing but for a long term of 5 years or 10 years, I am planning. That's investment. Whereas trading is nothing but every day I can do trading also in the market. I think as the vice chairman of the committee said, I can do trading and earn also. The later slide I will show you. You will be really surprised to see the returns. When there is an opportunity in the market, naturally you can make money by means of trading, but you have to have certain rules you have to follow that. One is treat trading like a business. I think all of you know that being a chartered accountant, the income from that trading is nothing but only business income. So you have to treat this as a business, protect your trading capital. That means what? You cannot stretch beyond what you are supposed to or what you are already capable of losing. Beyond that, you should not go that. Next is always use a stop loss. Without stop loss, trading is very, very risky. Keep trading in perspective. Use technology to your advantage. My dear friends, nowadays, a lot of apps are available for your day trading to give you what's called support, when to enter, when to exit, what price I should buy, what price I should sell. Even a trading also, I am telling you, gives you a lot of opportunities. How many of you know that options are there, futures are there, and particularly options are very, very cost effective. At the same time, you can leverage your money to buy more and have more profit also. But in the case of options, only one thing you have to remember is that rather in the futures options, one advantage for you is that even when market falls, you can enter into the market and you can make money. Please understand that. Unlike equity cash market, I cannot sell an equity unless I own equity for selling that. Whereas here, even when market falls, I can sell a stock in options or future and I can make a money. For example, when the TCS results have come few days back, 2 days back, I think, what happened? Then the stock fell heavily on that day, around 5% something. So there is an opportunity to earn when even stock is falling. I have to just do a short selling, rather I have to sell that stock and I have to buy at a lower price. I will make a money. Buy options, proper strike price I have to take, or I can buy the future of that particular script and do that also. Similarly, in options and futures, the difference is that by 10,000 rupees, suppose I want to buy a stock worth of 200, I can buy only how many stocks I can buy? 50 stocks only I can buy. 500 stocks, 50 stocks only I can buy. Whereas here I can buy more than that in options and futures. That's why that leverage is available. But leverage also always risk that will lead to more loss also. That's why you have to follow these rules. Develop a tracking methodology based on the facts. Know when to stop trading, which is very important. Like, we should not become addicted to an activity. We should know when to put a full stop. Then only you will be on the gaining side or you will be reducing the losing tendency. Otherwise, you will continuously lose the money and you will, rather your capital is almost lost. That's why this trading is always a risky proposal. Never, ever a person who retired should not enter into that unless he is a rather having full knowledge of the entire trading system. Otherwise, you should not enter at all. Whereas a person who is young, definitely he can learn. He can learn and enter. Even age. Hello? It's not coming? Oh. Now it is coming? Huh? Hello? Huh? Yeah, I will reshare it. Yeah, I will do it. I thought it is sharing. Are you able to see now? Huh? Sir, I'm sure. Okay, okay. Hmm? Okay, okay. I have to stop the video. Okay, right. So the trading system is different, investment is different, wealth creation is different. We have to understand these three things in order to understand the risk involved in three types of this. So trading is of high risk, investment is a moderate risk. Of course, wealth creation is no risk at all. Wealth creation. It's not moving, boss. Hello? It's not moving. My slide is not moving. Why? Moving. Not moving, sir. Moving. Please see, yeah, please see this particular thing I want to show you. In the case of options, please see this first item. Of course, it is taken long time back. I want to give you just an example. In 5 days, the return is 1,576%. Which instrument is giving you this much percentage? Another thing was given 870%, 645%, 370%, 328%. Just 5 days, 2 days. I mean, that means what? First case, if you take, a 60 paise has become 10 rupees 90 paise within 5 days, that option price. That's why I'm telling you, there are a lot of scopes are there for getting good returns in the case of options, futures, but risk also there. That's why it's important to know that you are learning everything and you are entering. This is a very, very typical example of phenomenal return which you can have. At the same time, a loss also can be phenomenal, but you must be in a position to handle the loss. How to mitigate the loss, you must be in a position to, rather you should have mastered the art of mitigating the loss. Then easily you can earn like this. Many people have made money like this, provided you have that knowledge. So these are the other things which I want to tell you is that wealth creation or value creation for your individual is, please start a SIP. SIP is very, very important, systematic investment plan. For anybody that matter, suppose I'm just 30, I'm having a goal of creating a corpus of some 1 crore or 2 crores at the time of retirement. Automatically, it will give you, suppose inflation is 7%, it will give you what I should do every month. What I should do every month, it will tell you very clearly. So you have to do this systematically, then that impact will be phenomenal. The creation of wealth will be massive. You will appreciate deliberately one day that, yes, you achieved what you want to achieve without any difficulty. So SIP can be easily followed. Not only you can put it in ETF, or you can put it in some good stocks, so that automatically it can go forever, for a period of 25 years or 20 years, whatever it is possible, you can plan it. Ultimately, at the end of the period, if you see the corpus, you will be surprised to see that. Why I am recommending SIP for people is that, first, it is a averaging methodology, so that when prices are coming down also, I'm buying, so that my averaging is happening automatically. Next is brings a discipline of investment. Please understand that. It brings a discipline of investment, so that I am not missing the habit of investment. As I told you in the first slide, I have to start with 25% of my savings. Even I used to say that your first expense must be the savings. So you can invest SIP to start with, so that a discipline will be brought into your life. Next is convenience. Very, very simple. You can start on any day. It may be your birthday, or it may be your wedding day, or it may be your children's birthday, or whatever it is. You fix that day. On that day, every month or every week, whatever choice is yours, every month you can buy that particular scrip or ETF, whatever you decide, with advice of a financial advisor. Next is power of compounding. This is what I want to tell you. In a SIP, the compounding effect is so much. That's why the corpus becomes a heavy amount at the end of the period also. Next is that it is convenience also. And achieving financial goals is possible very, very easily without much difficulty, so that the long-term retirement plans, you can start with SIP itself. You need not do anything. Just you have to invest every month. What kind of corpus you want, what kind of EMI you can put every month. Decide accordingly, the corpus can be decided, and you can put money on every month. Investment frequency, you can select either monthly or quarterly or weekly or what is called yearly. And you need not even, it's not compulsory also. Sometimes if you due to some problem you can miss it, but you have to make it up later on. Then only the corpus will be same. Otherwise the corpus will be disturbed. So please generate, in order to generate wealth, the SIP is the best mechanism. It is a very, very simple mechanism to ensure a wealth creation for you at the later stage, for your later stage. Otherwise, you will miss the bus. So youngsters, as I told you earlier, SIP should be implemented. Term insurance must be implemented. Others, health insurance must be there. Please understand, value creation happens to an individual, not only investing in bonds, FDs, etc. Also investing in insurance for life, already I told you. Similarly, for protecting the expenses relating to the health also, which is also important. So health insurance also leads to value creation for yourself. So please do that also. Ten ways to wealthy. This is very important. So value creation can be done, and thereby you will become wealthy. Reinvest your profits. See, normally we have tendency of plugging out the profits. Please do that. You must be a different personality. You should not, rather go by somebody's this. You have to follow your own rules. Never suck your thumb. Means if you fund something good, act. Don't exit when you are finding nothing. Be firm in that. Okay. Spell out the deal before you start. What you want to do, plan it properly. Watch small expenses. This is very important. Normally we think this is only a small expense. Why can't we do it? A small expenses like that will lead to heavy loss of money, and ultimately it will affect your savings. That's why always we have to watch the small expenses, because big expenses automatically we will focus, we will rethink, and we will do it. But small expense we never mind to spend. That's why you have to focus more on small expenses. Assess the risk, what kind of risk every product has. Then be persistent. Then know when to quit. You must know that when to quit. Limit what you borrow. Please don't borrow and invest. You have to do only with your own earnings. Don't borrow that. Only what I said is, first expense should be your investment, not later. Normally we used to say that one day if I have surplus, I will invest. No, you have to find ways and means that your expenditure, first expenditure is savings, then you have to do that. Then the success, you can easily see that. See, this is the Warren Buffett. I want to tell you, all of you, that never depend on a single income, make investment to create a second source. So the value creation for an individual comes only if you are planning in advance to create a second source of income besides your regular income. Normally, as a human being, we have tendency of spending money and not thinking of our future. So we have to do this. So if you buy things you do not need, you will have to sell things you need. Very, very, explicit statement that whatever I don't want, if I buy, then I have to sell what I want. That means what? Later on, you have to sell your house in order to meet your day-to-day things. Savings. Do not save what is left after spending, but spend what is left after saving. This is what I told you. The savings must be the first expenditure. Then you please spend whatever you want to do that. Never test the depth of river with both feet. According to your own age, according to your risk appetite, according to your target goals, you have to do the investments. Do not put, of course, everybody knows that, all eggs in one basket. Honesty, very expensive gift. Do not expect it from cheap people. This is very important things. So what my conclusion is that First part, I talked about value creation for the company. Second part, I talked about the value creation for the individual. So in the case of value creation for the company, I told very clearly that it is nothing but analyzing your products, all processes, strategies, and see that you are gaining a value in the competitive world. That you can do that provided you done a homework on the strategies of merger, acquisition, or bringing synergies, similar companies or new line of business. Like that, if you do that, then value creation is done for the firm. In the case of individual, value creation is done by acting upon proper savings according to the various methodologies. As I told you, you can be an investor, you can be a wealth creator, or you can be a trader. There are three types of available. Even in investment also, you can invest in various types of instruments. Already I told you, and you have to be very careful with the risk associated with each type of instruments. And my opinion, as I told you earlier, for a long term, you have to start SIP, as well as you have to take a term insurance, and you have to take a health insurance. These three things will definitely fencing your total wealth and give you a better life system. Rather, later on, it will support you very, very comfortably. Otherwise, you will lose the comfort life. So in order to ensure a proper retirement life, in order to ensure a proper value creation for yourself, investment is necessary, and those investments you have to put it according to various baskets. You should not put it in everything. Even for example, I can buy gold also. Nothing wrong in that. Normal rule is that 10% of my fund I can allocate in gold. Cryptocurrencies, yes. Now people are fancy about that. You can allocate 5 to 6% of your funds for cryptocurrencies. But what you have to keep in mind that still it is not regulated in our country as well as in many countries. Even a country which is regulated is facing a problem, which I already accepted cryptocurrency as a sovereign currency. They are in trouble now. So we have to understand the whole instrument. What is the instrument? What kind of risk is there? Why should I go for it? Is it necessary? If you do that exercise, then a proper investment model can be created. So my kind of advice was that you can be a trader also. In trading also, you can make money. I told you already. In 5 days, the return is 1,400%. Who is giving you this type of returns? Even in trading, why should you earn 1,400? Even you can earn daily 1% also. 1% you can earn. If you work out how much it comes for a year, more than FD. Of course, it calls for a lot of disciplined approach and also to know the subject matter. In the absence of subject matter, you may lose the money also, because in futures and options, there is a leverage. You are leveraging your money, you are leveraging your positions. So that it may lead to losses also. So with this, I am coming to the conclusion that value creation is very, very important for an enterprise as well as for an individual, so that the enterprise will have a pulling effect. Similarly, an individual will have a long-lasting, beautiful, comfort life. Thank you.
Thank you, sir. Thank you so much. Thank you for sharing very wonderful insights on this topic, and we have received a number of questions on this topic. So the first question is, in volatile market, how to manage? I think, yes, please. Yes, sir.
Volatile market, I think.
How to manage? Actually, yeah. I think the question is incomplete, but I don't understand in which situation we are talking about. But you can answer, sir.
So volatile market, of course, if you want to enter the volatile market, I think you have to be a little bit cautious, in the sense that what are the factors as of now affecting the market, you must know that. For example, as of now, the factors are, one is war is continuing, no end for it. Gas prices, that is oil prices, are fluctuating. Sometimes it comes to a comfort level, sometimes it goes up. And similarly, the rupee depreciates heavily. So a lot of things are happening. Similarly, the interest rates are hardening, and the inflations everywhere. Globally, if you see, all countries are facing heavy inflations, including US also. particularly stock market, one should know that why volatility comes into picture. For the past many months, you would have noticed, 2-3 months, you would notice the volatility is of very high order. Simple reason is the FIs are pulling their funds out. Why they are pulling out? Because there is interest rate up, rather rates being improved in US. So they are feeling that, why should I be in this market? I can be safe there itself. So this is the main reason why FIs are pulling out of the market. Whenever FIs are pulling out, there is a disturbance in the market. Market becomes high volatile. That's why even this month, July, once again, there is a problem because Fed meet is there, I think, last week of July, and inflation data of US is going to come last week of July. If the inflation is still going further worst level, then automatically the Fed will take further measures that will affect our market globally. Every market will be affected. Naturally, the market will fall. So as an investor, what you have to do is you have to understand this first. Then you have to decide what you want to buy in a volatile market. My advice to people is that in a volatile market, don't go for any mid cap or small cap. You should go for only a large cap if at all you want to buy. So that large cap will have always, fundamentally, they will be strong. Particularly, I advise, please go for Nifty 50 stocks so that they will be fundamentally strong in their various aspects so that you are not going to lose your capital. You may lose temporarily, but in the long run, you may not lose it. That's why you have to go for it. Because mid cap and small cap may be a gamble when volatile market is there. You may get profit, you may not get profit also. So this is the methodology you have to adopt. In case you have already some good stocks, then it's a time for you to buy more and average it in case you want to take the benefit of falling prices. In case you feel that while doing that also, the portfolio, what you want to create also must be careful. It should not be skewed towards one segment. For example, I should not put all my money in bank stocks. I have to put it in bank, chemicals, then other services, financial services, like that. If I do that only, I am spreading the risk. Otherwise, I'm not spreading the risk. So according to your portfolio, you can buy stocks which are available at good price, or the cheapest price, even at this juncture, but fundamentally they are strong. So fundamental analysis plays a great role when you decide or when you want to buy at the time of volatility. Because volatility will disturb all stocks. There's no doubt about it. But fundamentally, good stocks will not be disturbed to a great extent. It will be disturbed to some extent only. That's why you have to go for such stocks, sir.
Next question is, at what age do you recommend availing term insurance for youngsters? And what kind of premium should we expect to pay for a youngster?
See, so for example, the term insurance, as I said, even for 1 crore coverage is available. By inflation, everything, if you take into account for 20 years, even 1 crore is sufficient for you as an youngster to take the cover. And the premium will not be more than 6,000 or something like that. Even 1 crore, I'm telling you. And the 6,000 premium is forever. In the sense, for 20 years, you are going to pay only 6,000. Every month, you are going to pay that only. That means what? You are saving a lot. You are saving a lot. At the same time, you are protected to a big sum. That's why term insurance is the best. Because if I put as a normal insurance, my return is only going to be 4% or 3% or 4.5% only, which is not an attractive return. Instead of that, that money can be invested in a good return stocks or something so that you are leveraging your money. Otherwise, you are wasting your money for normally, we are all having a tendency of going for a money back policy or something on the advice of insurance agent. But it is not actually correct, because for creating a corpus for your education of your son, daughter, or wedding of your son or daughter, simply you go a SIP model at your young age, and you see that at the time when you want money, it will give you more than the insurance policy. I'm sure of it. I'm sure of it. That's why you have to do that. That's why youngsters should protect his life. Youngsters should start SIP at the earliest, so that you are having a corpus, and your corpus also protected when you are having some problem with yourself. That's why you have to aim at, and term insurance are damn cheap. Nowadays, every company is giving you term insurance according to, of course, your earning capacity only. The sum insured will be arrived. If you are earning a reasonable, good salary, easily you can have 1 crore sum insured, and the premium will be a meager amount only. Hello?
So next question is, um, most people I know in the market are doing revenge trading in derivatives. That is, they are in the loop of recovering loss. 4 options. Examples: you can't mobilize large sum of money because of high risk.
Mhm. No, what is the question, sir? Please repeat.
Most people I know in the market are doing revenge trading in derivatives. That is, they are in the loop of recovering losses. 4 options, examples: you can't mobilize large sum of money because of high risk. I think this is not the question, this is the statement only.
Yeah. That's why I'm telling you. I already explained to you. In options, of course, the cost of trading is very less. In the case of futures, the cost of trading is more, because you know that every transaction has STT, securities transaction tax is there. Then we are having turnover tax to the exchange. All elements are there. So when you do a future contract, these elements will be more. Whereas if you do a contract, including brokerage, I'm telling you, in future also brokerage will be more. Whereas in the case of options, the brokerage goes by the lot only. So the brokerage is minimal amount only. So that what I'm trying to say is that the cost of trading will be less in options, whereas cost of trading will be more in futures. So if you want to have a gain, quick gain in a day trading, then better is options. Better is options. Don't go into the future for 2 simple reasons. One I told you is that various cost of trading I told you. Second one is that you need more money to buy. If I want to buy a Bank Nifty future, I need more money. Whereas if I want to buy an option of some strike price, I need less money. At the same time, I am taking more exposure also without putting more money. So that advantage is there. As I said, the leverage is there, but that leverage alone, that leverage is nothing but a killing factor for some people who doesn't know the ABCD of the market. That's why many people, why they are losing money, by just listening to some tips coming on your phone, or somebody is giving you some idea, something like that. My suggestion to all of you is that very easy to learn options, very easy to learn futures, so that you can easily go through. How many number of videos are available on our internet? I mean, everything is available. Please just listen to that, and easily you will understand the game of that. Then you can easily go for it. As I said, the trading rule, if you follow the 10 rules, you are not going to lose. If you don't follow the 10 rules, definitely you will lose. For example, one of the rules is stop loss. If you don't put the stop loss, automatically your capital is eliminated in the first trade itself. Always you should have a risk-reward ratio. There must be a risk-reward ratio. According to that only you have to play in the market. If you play beyond that, your capital will be lost. That's why many people are losing. And one more thing, for a trading, I'm repeating, you must know the technical analysis. You must be in a position to see the graph. From the graph, you must understand what kind of movement is happening, why it is happening, where is the support, where is the resistance. All those things are very, very interesting thing, of course. If you learn that, easy for you to mitigate the loss. If you, without learning, by hearsay, you want to invest, then you will be the loser.
So, Suresh, actually, I have one question on behalf of the audience at large and for my own knowledge also.
Tell me, sir.
Nowadays, basically, a lot of corporate houses, they are doing buyback. So, how it is encountering the bonus offers in the public?
How?
How it is encountering to the bonus issue in the public?
Okay. See, when buyback comes, when corporates are feeling that they are having excessive cash in their hand, when they feel that they are having excessive cash, then they are coming to market to buy the shares. It gives the confidence, rather it gives a green signal to the investor that this company is doing well also. In my opinion, buyback is nothing but a signal to the investor that it is a good company, because by his resources he is buying back. That means he is confident of running the company by buying back. That means he is increasing his holding, rather public holding is coming down. So that is a good sign. So as far as bonus issue is concerned, I think there's no connectivity between buyback and the bonus issue. What happens is that if it is a bonus giving company, naturally the buyback will not be there at all. My opinion, it won't be there that much, because after all the cash is utilized. After all the cash is utilized for paying this buyback. If I preserve the cash and utilize it for the business and enhance the shareholders' net worth, naturally bonus can be issued. But the problem is many companies are not going for bonus unless they feel it is necessary for the purpose of raising some equity or anything. I mean debt. Otherwise, in a bonus issue, people are not going, or they want to reward the rather investors. They won't go for that. So buying back is different set of things. Bonus is different. So in my view, an investor who feels that this company is worth of rather giving by buying back, it gives a signal, yes, I can continue, you can continue. Or if you feel that, yes, better to surrender and get the money, yes, you can do that, provided your returns already good after your investment. In case it is not good, then you need not go for buyback, surrendering your shares. In case the companies has the tradition of giving bonus shares, you can wait. You need not surrender also. But always my suggestion to people is that whenever a company gives a bonus share, automatically you have to buy that company, because the value will be halved or reduced because of bonus shares, but it will come back to the original value. Many companies, good companies, because normally, fundamentally strong companies alone will give the bonus shares, unless there's a promoter's self-interest. Very difficult these times, it won't be there. So when such things are happening, it is also an occasion to buy that particular scrip. Suppose tomorrow Infosys says, I will give you bonus shares, write scrip to buy, so that you will, even you buy bonus, at that time you may pay the price, but later on it will come down. But subsequently, after some point of time, it will reach the same price. That's the beauty of bonus shares, getting bonus shares.
Has raised this. So the small question the participant raised it, that once the buyback is announced, the acceptance ratio is very low, and when the date is over, then the price of that particular share falls drastically. What is the reasoning behind that? So we have seen in case of Infosys, we have seen in case of GAIL, we have seen in case of many other companies, acceptance ratio is very, very low. So even if you apply for, you won't get anything, and the rate never reaches at the buyback price.
Yeah, that's the pricing also, buyback pricing also done on the basis of some formulas actually, based on last 6 months trader price, some methodology is there. So when they do that methodology and market is suppose far off from that methodology, naturally it is a good thing for the investor to give it and get the money. Then you buy it in the market, definitely it will be lower. Definitely it will be lower. But many times what happens, as I said, the investor assumes that since the buyback has come, why can't I continue to be an investor instead of surrendering it? So when those things are happening, due to some other development also, the price will come down. Due to some developments, not because of failure of the buyback or anything. The price mechanism is based on past prices, history of prices. Whereas the future price is not in your hand, why it is going down or up. So that's why in a buyback, you have to analyze where are you with regard to the price. Whether the market price is near to that price or over that price, then accordingly you can decide what you want to do. So many cases, people lose the opportunity of encashing the money by thinking that after buyback is over, the price will go up. because it's nowhere connected future price. Please understand that. Buyback is connected on the rather arrived at on the basis of history of prices, not because on the basis of future price. That's what I want to tell you.
Sir, a very senior member has asked this question.
Yes, sir.
What are the types of investments one can make at the age of 61? He's 61 years old. He's asking what are the types of investment one can make and what are the different FDs in the corporate that provide high interest rate, and how to choose the company deposits. And for SIPs, what are the different investments and give examples.
As I told you, 100 minus 60, 40% of your sum you can invest in equity. Of course, equity also you can do directly or mutual fund. Even within mutual fund, since you are 60, you have to go for balanced funds so that your capital also will be protected. Return also will be decent comparing to debt. If you go to purely debt, the investment will not be there. Next is 60% whatever you are having, you must have it in the form of FDs or debentures, as I told you, or in the case in the form of government bonds. Government securitized bonds also available. Rather, what I can say, even PS, public sector, Tier 3 bonds available. But the risk is with this type of Tier 3 bonds is that there is no guarantee that it is protected. It is not protected actually. Of course, in FD, up to 5 lakhs you are protected. Your capital is protected as per latest amendment. Whereas in the case of Tier 3 bonds, there's no protection. That's why high risk is there, high return will be there. Similarly, deposits, he asked how to invest in deposits of companies. Please see the ratings. If the ratings are good, top class, naturally, you know, all of you know that when rating is good, the rate of interest also will not be good. So a moderate rating will give you good return also on the deposits of a company. So it is my opinion, you should not be too greedy. So you should be moderate and go for a rating which gives you a reasonable return, not beyond that. Suppose I want to have a 12% return, the rating will be less than what it should be. So that, you know, you'll get more return also, but risk is there. So to avoid at the age of 60, taking risk aversion is should be avoided. So we must always ensure that we are putting in a well-balanced advantage fund in the mutual fund. Similarly, we can put it in the case of government bonds, we can put. Similarly, for senior citizens, there is a scheme, PM scheme is there, up to 15 lakhs, if I remember, you can put. That will give you a perpetual interest. I think it is 8%, I think, 7.5 or 8. It will give you perpetual interest for a period of 10 years, I think. It is locked, but it is very good instrument so that you can get, that's why I said balance 60%, you have to allocate like this. Easy for you to generate income also, because after retirement, you need income for your sustainment. So in order to ensure income, you have to put in this type of things where the capital also protected, at the same time you are generating a reasonable income.
The next question is, during split share and during bonus issue, both the times the share prices goes down. And then how is it beneficial to get bonus share?
Yeah, I explained to you just before a few minutes. When in the case of, for example, 100 rupees is the share value, bonus is, let us assume 1:2. That means that once you buy the share, 100 rupees, you will get one bonus share, but automatically your things will become what? 100 rupees, I buy one share, bonus share will come. That means you will get 2 shares, 1 + 1 you will get. That means the price of the share will come down to 50. Same 100, you will have 2 shares with you now. But the question is, when a company gives you bonus means it utilizes its reserves. When a company utilizes its reserves, that means it is a very, very good company doing profit year after year and accumulating reserves. So they wanted to make use of that reserve to reward the shareholders. So when such things are happening and the company's fundamentals are strong, automatically same price will come down. After a split or bonus shares, what price it has come down, we'll go back to the original figure of, or rather price before split and bonus shares, because of the company's fundamentals. If the fundamentals are not good, you may have a problem. Similarly, if the promoters interest you to see that, what is the promoter's share in that company, which you have to always look upon. If the promoter shares are more, let us assume 70%, public is 30%, bonus issue is made, that means he may do it for his own purpose. There is a possibility. I'm not telling that everybody is doing. There is a possibility for enhancing his own wealth. So what you have to be careful at that time is that you should not go for such things unless the company is fundamentally strong. That means top line growth is there, bottom line growth is there, then you can go for, and product is of unique nature and market share is of well settled market share, then you can go for it. Otherwise, just for the bonus shares, don't buy it. You have to see the company's total fundamental details, and then you have to decide that.
So the next question is, in the futures and options, whether individual stocks are preferred or index futures and options are preferred?
Yeah, it's a good question. See, it all depends on what kind of player you are, or what kind of capability you are having. Index, yes, very simple. Very simple in the sense, you need not analyze any fundamentals. You need not do anything. Simply, you have to see the factors that may affect the market. It may be international level, it may be local level, or it may be to the particular exchange level also. So you have to see that. If you are able to do that, then index is the best, for a simple reason that you can easily track the movements. In the case of company, a company prices may be disturbed due to various factors. It may have bad quarterly results, or suppose a US licensing authority for a pharma company denied for a particular product, then it gets affected. So you may not be knowing that fact. So when you go for options or futures, the simple thing is to go for the futures, bank as well as the Nifty. Please go for it. You do some trial trade in that. Once you masterize, then you come for the stock. While doing stock, you please assume that you are buying stock, like cash market. Don't think that you are in future or option. Even future market also, option market also, you can keep it as a stock. For example, I can buy July future of ITC. I can buy now. If some strike price, I can buy. Assuming, rather projecting that from this price, it will go to the higher price, I am buying it. In case it is not happening, then I must be in a position to roll over that stock if I am an investor. If I am a day trader, the game is over on the day itself. If I am an investor in options or futures, then I must be in a position to roll over that particular contract to the next month, and I have to pay a small difference, and I can hold it. Like an investment, I can hold it, provided you are strong enough to know that there is going to be a favorable position for that company. Otherwise, you may lose it. That's why when you have rather futures and options, stocks, for example, State Bank, I'm giving a simple example. The lot size may be 1,500. Just I'm giving an example for one lot in futures and options. So suppose I'm buying a strike price of, let us assume, 300 rupees, say 600 rupees, let us assume. So 1,500 to 600 only I have to pay. Whereas same stock I want to buy in cash market, I have to shell out heavily actually. That will be a huge sum for me also. So that's why leveraging is there in the options and futures, but you must be careful enough to understand the rules of the game, and you should master the art of doing investment in options and futures. It is possible. It's not impossible, it is possible. And you must know the tricks of the trade. Of course, there also a lot of strategies are there, like a straddle, etc. A lot of things are there to protect your capital, to minimize the loss. to maximize the profit. Similarly, what is option buyer, seller? A lot of things are there. We can take another class also. So that way, you should know everything. Then you can enter that. And similarly, you can make money in that. That's why, in order to prevent losses, first, you please enter a small level of buying one Nifty or one Bank Nifty. Because one Nifty is 25 lot, Bank Nifty is only 75. So you buy that, then you see what you can do for that. And one more thing I want to tell you, please do it only in the options. Don't go for futures because of cost of trading and the requirement of capital is very, very small instead of going for the futures.
Thank you, Suresh sir, for such a wonderful deliberation. I am really very delighted to hear you today, and I have seen the way you have delivered on both the areas regarding the investment of the individual and how to create the value for the corporate houses. That is really very much beneficial for all the members and attendees. So thank you, sir, for your this valuable time. And this is really very value addition again for the members. And I'm sure that the tips and tricks you have guided, the persons will certainly have a good wealth along with their good health in coming time. And they will certainly remember your tips. So, sir, I'm on behalf of the committee and on my own behalf, I thank you and all the attendees for this wonderful webinar. And I'm thankful to all the officers of the committee for arranging this wonderful webinar in the interest of the members at large. So thank you one and all. Thank you.
Thank you, sir. Thank you, sir.